One stock which has been a bit all over the place this last 1 month is HDFC. First, on the concerns of PSU competition, that stock got hammered from 1450 to nearly 1150. And then in the last few days, we've seen a very strong comeback, which yesterday culminated at 1400 plus, and subsequently HDFC is now trading between 1350 and 1400. Lots of issues surrounding the company. To talk about them, Keki Mistry of HDFC is with us now. Keki, morning. Thanks for joining in.
Morning.
First, the advanced tax numbers which came out yesterday caused a little bit of concern, but they should not be looked at as an indication of negative Q4 numbers.
No, I think let me explain the advanced tax numbers. If you take the year as a whole, the advanced tax that we paid for the current year is 950 crores. Last year, the advanced tax paid was 930 crores. So there's an increase of 20 crores. Now, last year's 930 crores includes advanced tax on sale of investments. Last year, we had exceptional income. We sold our stake in Intellinet, which is a BPO company. Standard Life increased a stake in the life insurance business. Ergo bought the general insurance business. So we realized profit on those investments. And the tax on that was about 170 crores. So out of the 930 crores, if you remove 170 crores, you come to 760 crores. So the adjusted tax figure of last year was 760 crores, against which in the current year it is 950 crores.
Fair enough. The one concern on HDFC has been that after so many years of growing at a very fast clip, the home loan market might actually start slowing down significantly starting next year. It has already. Do you think you will clock less than 20% home loan growth next year?
Like next year's, if you ask me my outlook today, and it's something which we are reviewing on a consistent basis.
The year starting 1st April.
Year starting 1st April. I would believe that if we take the year as a whole, we should be looking at a growth of around 20%.
You will manage that, you think?
We believe we will be able to manage that. Now, the reason we believe we'll be able to manage that is that the number of inquiries we are getting into our office in this quarter, for example, is significantly higher than what we were getting in any quarter in the past. But it's just that people are concerned with property prices. People believe that property prices have not bottomed out. There is scope for property prices to come down. So a lot of people are just holding on to their purchase and the expectation that prices will come down further. In actual practice, if you look at it, Udayan, any project that is being launched today is being launched at a price which is 20, 30, in some cases even 35 and 40% lower than what a similar project would have been, say, 6 months or 9 months or 12 months ago. So prices have indeed come down for new projects.
But are people still holding on for more reductions?
See, usually when prices come down, no, many people are buying. Lots of people are buying, which is why if you see this quarter, we'll see higher growth. I don't want to get into quarterly numbers, but we'll see higher growth than we would have seen in the previous quarter. But still, there would be the odd person who will hold back thinking that prices will come down further. So you need to see prices stabilize at some level, and then you will see the growth come back. So if you ask me for the year as a whole, I would continue to believe that we should be looking at the growth of around 20%.
Now, what is the bigger risk to that 20% number that you're talking about, that you're confident about? Is it that the overall market will slow down below 20%? Or is it that competitive forces will eat away market share and you may not grow at 20%?
If you look at competition over the years, it's not that we are seeing competition for the first time. We've seen much more severe competition, say, for 3 years or 4 years or 5 years earlier, when we had all the private sector banks, we had the foreign banks, we had the public sector banks, all aggressively going and pushing housing loans. So competition is not something that is new to us. It's not because of competition. The fear, if any, of why a growth of 20% would not happen next year would be more because people believe that prices would come down still further. And, you need to see correction in prices, which we are now beginning to see. And then you need to see some stability in prices for a couple of months, maybe 2 months, maybe 3 months, maybe a little more. And then I think you would see the growth come back.
Your point is taken about private sector competition always being around. ICICI, etc. have been fairly vigorous competitors. I think the market has got suddenly a bit concerned about State Bank of India, not just because of that one offer, but because they have recourse to such low cost of funds. Could they become very significant competitors as a class, the PSU banks?
I think, Udayan, if you look at the cost of funds, we've discussed this so many times in the past with various people and with analysts and with various people. If you look at a model, a housing finance company model, we don't have access to current accounts and savings accounts, but we do have access to retail deposits, we do have access to wholesale funding. Banks have access, of course, to current accounts and savings accounts, but there are regulatory costs that are imposed on banks. There is a CRR, there is an SLR, there is a priority sector lending requirement. So if you equate all that, if you take that CRR, SLR, priority sector lending requirement into account, you'll find that the effective cost of funds for HDFC and a bank is more or less the same. Because the CRR and SLR is on the entire deposit base of a bank, Whereas the current accounts and savings accounts, the CASA deposits, would be only in respect of 25 or 30 or at best 35% of the total borrowings of a bank. So it all comes down to this more or less the same level in terms of cost of funds. Then you take into account asset quality. If you look at it historically from the time we started business till now, our total historical loan losses, and this is cumulatively in 31 years, has been 4 basis points. Even in this difficult year, you've seen that this year has been difficult for the entire sector, for everyone. Our non-performing loan level in every one of the quarters that we've reported so far, March, June, September and December, has been the lowest level that we've seen for a long, long time.
Can you hold on to that this year, you think?
We would like to. We hope that we should be able to.
No additional delinquencies you see in this environment?
Obviously there would be some additional delinquency. There is someone who was delinquent earlier who gets paid off. So we're not seeing anything extraordinary in this quarter which would give us too much of concern. Yes, some delays are there, but the delays, to my mind, will not result in NPLs.
Are you saying that SBI plus some of the...
Yeah, can I just add one more thing to this? So one is asset quality, the other is cost of operations. Our expense to asset ratio in 2008 was 32 basis points. So we are just spending 32 basis points of our total assets as expenses. Whereas if you look at a similar ratio for any bank in India, it will be upwards of 2%. So that gives us almost 1.7% advantage over banks. So on that basis, if you work out a return on equity, you will find that our return on equity is much higher than that of banks.
The point is that when we speak to the public sector banks, they seem to be getting very aggressive. And when aggressive people want to get market share, they may actually make interest margin sacrifices which HDFC has not made in the last many years. I mean, you want to stick to that NIM number down the years. Do you think that might put pressure on your margins, or you will have to sacrifice market share?
Look, we've never been in a market share game, Udayan. I mean, historically, even 3 years or 5 years ago, when we had so much of competition from the private sector banks, we always told our investors that we have 4 targets we set for ourselves. One is increasing our return equity every year. The other is reducing our cost-income ratio every year. Third is asset quality, which is reflected in the 4 basis points historical loan losses. And the fourth is targeting a growth that we are comfortable with. And that growth level that we are targeting next year is 20%. So notwithstanding the competition from public sector banks, or for that matter, theoretically private sector banks come to the market, we are still confident of a 20% growth.
And 20% with the margins which are pretty close to what you've done this year.
We would expect margins to be in the range of 2.1 to 2.2%. If you again look at it over the last 6 years or 7 years, you'll see that in every year, margins have been between 2.15 and 2.20%, with the exception of last year, when margins had gone to 2.32%. Last year's margins went to 2.32% because we had raised equity in the previous year. Until such time as the money was invested in the bank and the insurance company, which is what it was intended for, it was invested in income earning instruments. So the net interest income for last year was higher, which resulted in higher spreads. But 2.1 to 2.2 is we are comfortable with that margin level.
You spoke about your cost of funds versus banks, but CRR and maybe even SLR will come down progressively, which will release cash for the public sector companies. In this environment, because cost of funds is becoming so important, is the HDFC board or the management rethinking that old merger plan or merger talk with HDFC Bank?
Right. This is something we've debated time and again over the last so many years. And we've always come to the conclusion that the cost of creating the CRR and the SLR is huge. Let me explain this to you. We have a 950 billion rupee balance sheet. Now on 950 billion rupees, if we become a bank, then on the entire 950 billion, we have to provide CRR, SLR and do priority sector lending. Just the CRR and SLR will cost us about 300 to 350 billion rupees, which is a huge sum of money. We are talking of 35,000 crores of rupees. So to borrow 35,000 crores at a higher rate and then to go and deploy that money in lower income earning instruments just doesn't make much sense.
So fundamentally it makes sense, but that's the stumbling block, you're saying?
It has always made sense. I mean, from 94 we've always said that. But the CRR, SLR, the regulatory costs of a merger are just too high. And the model, as a model, is working very well. It's not that the model is not working. Our cost of funds is fine. Our asset quality is fine. We believe that the growth in housing will continue to be strong. You know, if you look at penetration of mortgages in India, it's 6% of GDP. Let's forget the West where it's 80 and 90 and some places more than 100%. But even if you look at other Asian countries, they're all in the 20 to 25% range. China is a little lower at 12, but everyone else is between 20 and 25. We are 6. So even if 6 becomes 12, we are looking at a doubling of the existing stock of housing loans in the country before we even remotely get to a level of saturation.